Closed-end funds are a terrific way to get exposure to alternative investments because alternatives tend to be lower liquidity than many other asset classes. Alternatives are generally defined as something that has a low correlation to traditional stocks and traditional bonds. They create portfolio diversification. Where we invest at Brookfield is in the real asset space within alternatives. That is real estate, infrastructure, and natural resources. We're investing in publicly traded stocks and bonds in those spaces. What we find attractive about those spaces is that in addition to delivering portfolio diversification, which all alternatives deliver, real assets deliver inflation protection, long-term capital appreciation, and a healthy amount of current income. Let's talk about inflation protection. That's a very important concept now that we're in an environment where we have rising interest rates, rising inflation expectations, and hopefully rising economic activity. If you have assets in your portfolio that move up with inflation, you are protected from inflation eroding the value of your cash flows. If you look at real estate, many real estate leases are indexed to inflation, so the rent goes up every year with inflation. Many infrastructure assets are regulated. The government establishes pricing, and the pricing is allowed to increase every year with inflation. Natural resources, energy, metals and mining, and agriculture, really is one of the definitions of inflation. As energy prices move up, as metals and mining prices move up, those are components of inflation. So by exposing your portfolio to those asset classes, you are protecting yourself from inflation. So as you consider an investment in real assets, most people historically have allocated to real estate first. So real estate is probably already in your portfolio. The next allocation historically has generally been infrastructure. It does provide the same investment benefits as real estate, inflation protection, capital appreciation, and coupon, but it does it in a low volatility way. And that's simply because the supply and demand drivers of real estate and infrastructure are very different. And if you think about every day of your life, whether the economy is good or bad, you will wake up, you will turn on the lights, which is energy, you will brush your teeth and take a shower, which is water, you will check your iPhone first thing in the morning and 100 times a day, and then you may or may not travel through an airport or travel on a toll road. So you see that demand is very steady for infrastructure. Layered with very limited supply, you have a very predictable, low volatility cash flow stream.